The S&P 500 is the most popular index for investors to track, whether it's in a mutual fund or exchange traded fund or ETF. But there's a thing with it that you got to be aware of, or it could really trip you up and really mess up your portfolio and put it out of balance. So we're going to learn all about that. And what is that dirty secret about the S&P 500 coming up? Welcome to Investing Education with me, Mr. B, where we help you to learn fast so you can become a confident and successful investor. If that sounds very interesting to you, hey, do consider hitting that subscribe button. All right, let's talk about the S&P 500, and there's this little piece of it that you have to be aware of, otherwise it could really kind of mess you up. It's really a true thing you're going to look at, and I'm going to show you in great detail, real quickly, but I'm going to show you exactly what we're talking about and how you can evaluate it and actually use it to evaluate other mutual funds and exchange traded funds and index funds that you might be investing in right now. So let's look at that S&P 500. So first off, as you probably know, the S&P 500 tracks the 500 largest USA stocks, and it's based on market cap. All right, so it's not based on sales or profit, it's market cap, which is the number of shares available, how many shares are available, times its current stock price. So market cap goes up and down every single day. And these are the largest companies in the United States, so it's not worldwide, it's the US only, 500 largest USA companies by market cap. Okay, so now we know a little bit about more, you probably knew, but let's say a little bit more about the S&P 500. Now think to yourself and maybe put some guesses or thoughts in the comments what you think this whole kind of clickbaity, I guess, dirty secret, or something that's maybe you need to be aware of when investing in the S&P 500. We know it's 500 stocks. That's pretty good diversification. It's 500 of them. We know it's large cap. So if you think, well, okay, the problem is, or the dirty secret, well, it doesn't have mid cap or small cap or mid or smaller companies. Well, that's true, but that's pretty obvious. What we're going to look at is something that's not obvious at all and really trip people up. So throw some thoughts in the comments if you can guess at it. It's a great way to kind of stimulate your mind and learn as well. So let's take a look at the S&P 500, and I'm going to use a mutual fund to really walk through it, and I'm going to show you exactly what I'm talking about and something that you want to really look at when you're looking at really any mutual fund, but particularly that you have an understanding the S&P 500 fund, because so many people say, oh, I'll just buy the S&P 500 and that'll be pretty not real risky and all that, and I'll have a good diversification, pretty safe. Well, they might be wrong on that. So let's take a look. Okay, I happen to be here over at investor.vanguard.com. We're going to look at Vanguard's S&P 500 exchange traded fund. And it doesn't matter that it's Vanguard. I'm using Vanguard as an example. It could be Fidelity, it could be Charles Schwab. No matter what S&P 500 fund, they're all going to be almost exactly the same. That's the whole idea of following an index. So don't let that throw you off. And I'm not endorsing Vanguard or anything. They've been in the index fund business for a long time. And it's very intuitive as we discover this little thing to be real concerned or be wary of when investing in the S&P 500. So if you've been guessing there in the comments section what it might be, maybe you think it's like around, something around price, performance. No, it's not that, or the management or fees or whatever. In fact, fees for like these exchange trade funds, so we click on that, you can see that this particular one here is at a 0.03 expense ratio. And the average in the industry, they're saying for similar funds is 0.83. A lot of funds, it used to be the thing if you want to be below 1%. So 0.03 is very extremely low. So it's not that. That's always good. That's why you would buy an index fund, particularly like, let's say, a fund like this at a 0.03. Now, I think where the thing that a lot of people don't see or realize, and they think, well, I'm going to get the 500 largest U.S. stocks, and I'm going to have a lot of diversification. It's 500 stocks, a lot of different companies in there, and it's going to be equally weighted. And that's the problem. It's not equally weighted. So we're going to go down to portfolio management. If you're looking at another fund company, you'd want to look under holdings, for example. And you can see that's what we expect stock style. It's a large cap fund, the index fund, and then it's got a blend of different things, both value, which is really dividend stocks like Johnson & Johnson, for example, Coca-Cola pay dividends, and growth stocks like Facebook or Amazon that don't pay a dividend, but you expect them to have a lot of growth, right? But if we go back to our overview here, and we're going to go looking for the holdings in here, the portfolio composition. And here, if we scroll down, we found it here, right? So here's the portfolio composition, or holdings is another thing you might see on other sites. What that means is, what is it actually buying? We know it's buying the 500 largest US stocks, but is there more to it than that? And there is. So this shows you, the equity sector diversification. So these are the different equity sectors, equity being the stocks, equity and stocks mean the same thing. And the different places we have companies, right? So you have communication, consumer discretionary, consumer staples, different things, financials, which is like banks, healthcare, like pharmaceuticals, information technology, which would be like your technology stocks, real estate, and so on. So you can see all these different sectors. And a lot of folks think, well, the S&P 500 is basically going to be equally weighted between the sectors. And the actual answer to that is it's not. The S&P 500 is weighted by market cap, which is determined by the share price of an underlying stock holding and the number of shares out there. So when you have a rise in certain types of stocks like technology, they take a bigger share, right? So something that hasn't done as well, for example, is like energy stocks, right? At least in the time of this recording, companies like ExxonMobil and all that. And you can see just energy stocks and how many energy stocks there are in the S&P 500. There's not many, so it's only 2.5% of the holdings, right? So if you're interested in getting energy stocks, you're not going to get much by buying from the S&P 500. What you are going to get a lot of is technology. And if I was to say this is the dirty little secret, or something to be certainly aware of, when you buy the S&P 500 index funds, you're buying a technology fund. 27% of the holdings are in technology. Almost a little over a quarter of all the holdings are in technology, and the rest are spread out between others. The next biggest are healthcare. So you get a lot of healthcare. Consumer discretionary, which would be things like buying, maybe like a car automobiles would fall in discretionary. You don't necessarily have to buy a car all the time. Versus a staple, which is you do need to buy food. So that's consumer staples. So you're buying consumer discretionary, maybe like a cell phone would fall in here, cell phone company. And then you're also getting a lot of financials, banks, right? And you're not getting a lot of other things like we mentioned, energy, real estate companies, utilities. You're not getting much of that. So if you wanted something that was a little more safer, a little heavier in things like utilities, you're not going to get that with an S&P 500 fund. You're basically buying a technology, more of if you really add it together, a technology discretionary, consumer discretionary, and healthcare fund and financials. So it's actually more concentrated than you think, and that's where it trips people up. Is they're like, oh, I thought I had a lot of diversity, and you do have 500 stocks. It's just you're getting a lot of technology stocks. And what do we know about technology? They're more volatile. They go up and down in price. So if you're somebody who's more risk adverse and you don't like that volatility, you want more things like utility stocks, then you might want to buy more of something that's heavily oriented towards utilities, a utility fund or utilities being things like gas, electric, those types of things, than like the S&P 500 fund, which a lot of people think, and can be a core holding, just it's much more volatile. Another way to look at this too is if you look at an interesting thing, because it doesn't necessarily match up with the benchmark because they're always buying and selling. They actually have 507 in this particular fund. They try to keep it close, but it varies a little bit. But the other part, so it's okay, it's just a little bit of variance. But the other thing on this you can look at is, if you look at here where it says, net assets of the 10 largest holdings, right, is 28.6%. So it's not really spread out between 500 different individual stocks because of how this is weighted by market cap. Your 10 biggest holdings are almost a third, well not a third, almost 30% of the entire 500 fund. So really what really counts is the 10 big guys. Really counts a lot more than maybe his numbers, 480, 498, 499, and 500 counts for very little in the overall investments in the 500 fund. So you're actually more concentrated than you may think in an S&P 500 fund. In fact, if we look down here at the 10 largest holdings, they usually update that every month, so just by month end, 28.6%. Now look at some of these holdings, and we talked about a heavy weighting towards technology. So what do we see here? Apple, Microsoft, Alphabet, which is Google, that's the parent company of Google, Amazon, Facebook. These are all technology companies. Tesla, their founder, will actually argue that they're not an automobile company, that they're a technology company because of the technology they develop and use. So if you want to argue for Tesla, you could say you got 6 companies. Now you got Berkshire Hathaway, which is a lot involved in finance and insurance. That's Warren Buffett, is basically his holdings. NVIDIA, which is also a technology company. Then you get a big bank, JP Morgan Chase and Company, a big bank, and a big pharmaceutical company, which also does things like Band-Aids and other things, as well as vaccines, Johnson & Johnson. So this is where it really trips a lot of people up thinking, oh, I'm going to buy these 500 diversified stocks, and they end up not finding out that, boy, this seems to be real volatile. Well, it's because it's very heavy in technology, especially right now, very heavy in technology. So something to consider, and that would be really the dirty little secret as far as the S&P 500 index funds. Well, there you have it. I hope you found this video informative and maybe a little bit enlightening, maybe even a little surprising. Hey, next step, go check out some of the information below in the description. We have some free courses, free guides. We have some paid courses, big comprehensive courses where you can learn even more, or check out other videos at Investing Education with Mr. B on YouTube. Go check them out as well. And if you really found this to be of value, really would appreciate it if you hit that subscribe button, maybe that like button, and give it a like, and go check out another video and learn some more. Because if you can learn more, you'll become more confident and you'll become a successful investor.